As a stock market investor, you can't possibly look at and evaluate each of the tens of thousands of publicly traded companies individually. However, you can reduce this enormous number. By examining specific key ratios, you can narrow down a list of opportunities that are better than average. The intelligent investor, like an expert chess player, wants to weed out the mediocre or even stupid moves from the start. Let me show you a strategy that has proven to be extremely profitable for me since I began investing in 2013. How do you locate excellent investment opportunities? Do you poll your friends and family? Or perhaps you should imitate the investments of a popular YouTuber or Twitter user. Both approaches are unacceptable to me. You can't buy what's popular and do well, says Warren Buffett. I'll show you a third option shortly. There are many things you want to see when investing in a stock market company. Preferably, the company should be inexpensive, capable of paying out large sums of money to you as a shareholder, financially stable, growing, with experienced and dedicated management, a so-called moat that keeps competing businesses at bay in a favorable political situation, and so on. Some of these things can be checked in a matter of seconds, while others may take days or even weeks to comprehend, depending on your level of ambition. When I invest in the stock market, I look first at the easy-to-check variables and eliminate companies that do not meet them. You will not be admitted. If you do the same, you will save a lot of time and be able to focus your efforts on opportunities that are above average. After all, I believe that the majority of us would like our hourly wage to be as high as possible. When Warren Buffett first started investing in the 1950s, he plowed through elephant books like the Moody's Manuals to find investment ideas. These books were thousands of pages long. Fortunately, we no longer have to do that because we live in the digital age. Many investment research platforms can now assist you in your search for outperformance. And in recent years, the best one I've used is called TKR. As a serious value investor, TKR.com is truly a one-stop shop. Here you can search for stocks from around the world and analyze them using high-quality data that is all in one place. Let me walk you through the process step by step. Step 1. Assessment. This is an entirely new Ferrari. Do you want to purchase it? This is a trick question. You can't answer it because I haven't told you the price yet. There is no such thing as a good or bad idea, regardless of price, says Howard Marks. Nobody, I believe, is more ignorant about how much they are paying for things they buy than people in the stock market. Consider what legendary investor Peter Lynch said. Although it is sometimes easy to forget, a share is not a lottery ticket. It is a business ownership stake. As a wise investor, you should always ask yourself, how much does that share of ownership cost me? To continue our car analogy, it isn't always the guy who owns the Ferrari who comes out on top in the stock market. It's usually the guy who got a good deal on a Toyota. So when I'm looking for great stock market opportunities, I first ask myself, how much is it? On ticker.com, you can do this by going to the global screener and entering your first filter. I begin by selecting the countries in which my broker allows me to trade. There's no point in wasting time on a South Korean company if you can't buy it later. I can speak from personal experience. Then I exclude sectors that I believe are outside my area of expertise. For me, the term finance refers primarily to banks and insurance companies. Remember what Warren Buffett's right-hand man, Charlie Munger, said. We have 3 baskets for investing, yes, no, and too difficult to understand. For filtering out companies based on price, I like to use either EV/EBIT or a simple PE. I don't want to pay too much in comparison to my earnings. We will employ a metric known as trailing TV/EBIT. TV, or total enterprise value, is the company's market capitalization plus all liabilities, minus cash and equivalents. I believe I prefer EV/EBIT over PE because it penalizes companies with weak balance sheets and benefits those who have powerful ones. For the time being, let us set this number at 15. This is a fairly strict criterion, but at the end of this video, I'll show you how you can be a little more flexible. Price, and more price. You will miss out on a few opportunities if you exclude expensive companies. However, it is also true that you'll avoid many more errors. After removing the most expensive companies, we are left with roughly 20% of the total universe of stocks. We're one step closer to finding great market opportunities, but there's still work to be done. A low-cost company is a good start, but I believe we can do even better. Let's get back to the other topics we discussed earlier. If a company has a high return on assets, it can usually throw off a lot of money in the form of dividends and share repurchases for you, the shareholder, ROA. A high return on assets reveals a lot about the success of the business. Consider the following. Bob owns a restaurant for which he paid $2 million. In other words, he paid $2 million for his asset. It generates a $200,000 profit per year. Stefan owns a restaurant for which he paid $4 million. This one also generates a $200,000 profit. Which restaurant, all else being equal, would you prefer to own? That is indeed Bob's. Bob has a 10% return on capital, while Stefan has a 5% return. Don't just believe me, Charlie Munger famously stated. Long term, it is difficult for a stock to earn a higher return than the underlying business. If you hold the company for 40 years and it earns a 6% return on capital, even if you buy it at a huge discount, you're not going to make much more than a 6% return. While it is true that past performance is no guarantee of future results, this is highly dependent on the type of metric used. It turns out that historical ROA is a fairly accurate predictor of future ROA. Assume that we require a ROA of 10%. This means we're down to about 1% of all listed companies, which is fantastic for your time management. We'll soon go over each company individually, which may be where Ticker really shines. But there's one more thing I'd like to include in our screening process first. Step 3. Development. Some investors believe that the most important factor to consider when valuing stock market companies is growth. It would be if one could predict the future. The issue is that historical growth rates aren't particularly reliable predictors of future growth. Take a look at this company's impressive growth. Depending on your level of optimism, you may have predicted a 20% increase in future growth up until 2014. However, growth abruptly ceased, and shareholders who purchased at high price multiples in 2014 and 2015. Since then, returns have been slow. Biogen is a large pharmaceutical company. While I'm cherry-picking here, it is true that all businesses experience growing pains. It is true that past performance is not a guarantee of future performance in terms of growth. Furthermore, historical profit growth is less predictable for the future than historical revenue growth. Compare this to the previous strong relationship for ROA. Having said that, I'm slightly more favorable to companies that have historically grown versus those that haven't, so let's use Ticker's screener to at least exclude companies in decline. Step 4. Dependability. So in just a few minutes, we were able to reduce tens of thousands of options to a short list of about 600 above-average opportunities. Simply increase the thresholds for the 3 variables we've discussed to make the list even shorter. You may have noticed that many of the criteria we've used are based on earnings. So the next step is to ensure that they weren't a fluke, a one-hit wonder in the world of investing. Sort the companies by the most important metric, or price, and then examine each one individually, beginning at the top. AIK Fotboll AB is a Swedish company located in this area. Assume we click on it and examine its financials. We can clearly see that EBIT, also known as operating income, does not appear to be very consistent over the last 12 months. It appears to be a fluke in comparison to previous years and is unlikely to be repeated by the company in the coming years. As a result, we'll disregard this one and move on to the second company on the list. If we keep excluding companies like this, we'll soon be at number 18. This is a Japanese company called Aegis, which provides inventory and other retail support services in Asia. If you're looking for undervalued stock market companies, this is a good place to start. However, you may not have easy access to Japanese stocks. Then, further down the list, there are a few names you might recognize, such as Facebook, Merck, UPS, BHP, and Target. Step 5, take a deep dive. There are more things to evaluate from here, depending on your level of ambition, and Ticker can help you with that as well. Almost all public filings of companies are available. Transcripts of live presentations are available. There's even a list of recent insider transactions and insider ownership. TCAR can assist serious investors in locating opportunities without relying on others. You're no longer doing what everyone else is doing. You're conducting your own research, so you're much less likely to be just another sheep in the herd. Have you ever wondered why fund managers can't outperform the S&P 500? They're sheep, and sheep are slaughtered. Gordon Gekko may not be the best role model, but he's correct on this one. A great investor exhibits contrarianism. As an added bonus, you could tailor your screener to your own investing beliefs. For example, you may believe that an EV/EBIT ratio of 15 is too stringent. Then I'd like to remind you that the higher this multiple is, the greater the pressure on your company's future performance. If you still don't agree with me on this, then raise the EV/EBIT by 50% or so while being stricter on ROA and revenue growth. Or perhaps you want to be extra cautious with companies that have weak balance sheets. Then add another criterion, such as a debt ratio and/or a current asset ratio. With TCAR, you can filter through a massive amount of data. This is very similar to how I find stocks currently. Many of the stocks I currently own are on the list I previously showed you. I've been using Ticker for about a year. It's the best deal I've found for such a service. And you can get started by clicking the link in the description. If you act quickly, you can get a 15% discount by using the code TSI15. Guys, cheers!